Rasa Ride Sharing Company arasa.ca என்ற இணையதளத்துக்கு சென்று Rasa Drivers ஆப்பினை டவுன்லோட் செய்து டிரைவர்ஸ் ஆக வேலை வாய்ப்பை பெறுங்கள். மாதாந்தம் $4000 வரை சம்பாதியுங்கள். வணிக நிறுவனங்கள் Rasa இணையதளத்தின் மூலம் மளிகைப் பொருட்கள் மற்றும் உணவுப் பொருட்களை விற்பதோடு வாடிக்கையாளர்களுக்கு டெலிவரி செய்யலாம். தமிழில் தகவல்களை அறியாளையுங்கள். GTA பற்றி 40 ஆண்டுகள் அறிந்து கொண்டவரும் வீடு விற்பனை துறை ஊடாக மக்களால் அறியப்பட்டவருமான சிவா பிள்ளை. 416-854-0005. Taxi broker licensed by City of Toronto.
Pension
Recording
plan
in
doesn't
progress.
matter whichever country you live. Canada pension plan, CPP Canada pension plan, whatever the money you pay for the pension, you're going to get back as a return. Government not going to give you free. This is your contribution you made. The base on the contribution, if you are over 18 years of age, until age 65, you can contribute. When you contribute, the Canada pension plan income minimum 3,500. First 3,500. What are the pension you contribute? Government will pay return back to you, and they don't consider you under the pension category. If you any of your income over $3,500 or more, you are coming under the pension contributor. And everybody have a different income level, but every year we have a pension limit amount. That's mean 2022. This year our pension limit amount 64,900. If somebody make 30,000, 40,000 and 65,000 or 200,000, their ceiling is 64,900. If somebody's income is 64,900 in 2022 or any limit, we are considering the pension limit as a ceiling limit. If you have a 40 years contribution, you will get the full benefit of the Canada pension, full benefit. At least one payment is enough to get the pension. That's number one, Canada pension. Second one, old age security pension. Old age security pension created the purpose of non-working spouse who stay in Canada, who stay home and look after the kids and so many other reasons. Old age security pension. Old age security pension requirements, again, if you live in Canada 40 years, between the age of 18 years and 65 years of age, doesn't matter how much money you made, only the residency status. If you live in Canada for 10 years, you are eligible to get the old age security pension. And more than 10 years, if you start to live more than 10 years, every year increase, you get 1 by 40, 2.5%. Your pension limit may go higher. This is old age security pension. In order to get the old age security pension, you have to live in Canada for 10 years. And if you live in Canada, Assam, your question is coming under this part. If somebody live in Canada only for 10 years and they leave the country, or you have to qualify to live in Canada 10 years. After 10 years, if the particular person leave the country, they can receive only up to 6 months. After 6 months, it's terminate. You have to inform the old age security department you're leaving the country, and they will give you first 6 months. After 6 months, they terminate. But if you come back to Canada and go back again, you will start to get again the pension. When you come back to Canada, you don't need to live 6 months in Canada. Once you come back in Canada, and you can leave again, and you will start to get the old age security, the pension. If somebody live in Canada 20 years, that's Liberal government bring this new rule 2-3 years ago. I think it's 2 years ago. If somebody live in Canada 20 years, regardless of the income, 20 years, and after 20 years, they are qualifying for the old age security pension, 65 years of age. If they leave the country and going to start to live in the country, they don't have the 6 months qualification to come back to Canada. They can permanently live in any other country, and they can still get the old age security pension. And the third one is old age security supplement. The guaranteed income old age security pension. Whoever receiving the old age security pension, they are eligible to get the old age security supplement. That supplement, just you must live in Canada. Even though you live in 20 years in Canada and you leave the country, and you can able to get the old age security pension, but not the supplement. Supplement will stop after 6 months you leave the country. Even though you have to come back and go and everything. The supplement is one of the special money they're giving the seniors to keep the standard of living, because if somebody live in the lower income bracket and they don't have any income at today's standard, government like to give old age security supplement. That supplement is ceiling is as for 2021 ceiling $18,648. That means if we are getting only pension, and if you have any other teacher's pension or government pension, any other RIF payment, RIF only start after 71 years. Anyway, if you have any other payment, you don't get the supplement. If you are without any other extra pension income, your income is less than $18,648, just you can get the supplement. The supplement money is a tax-free money. You don't have to pay for the taxes. That's based on your married status, single, married, whatever the status you have. If it is married, that's going to be considered for the spouse income and spouse pension and other things. And the eligible based on age and how long you live in Canada and those kind of things. And supplement money again, the guaranteed income supplement, whoever receiving the old age security pension only, they can receive the supplement. Okay. The maximum supplement you can get, that means your income is less than 18,744, and the maximum supplement you can get $923.71. Mostly our Sri Lankan peoples who never work in Canada, they come here in Canada and they live in the house. They start to get after 10 years, they starting to get, but what they're getting it, 25% of the old age security pension, 20%, because 10 years, 20% of the old age security pension, and the rest $923.71 as a supplement. Hassan, your question, if somebody, the question, the people who leave the Canada after 10 years, they had to come back every 6 years. They lived in Canada 20 years and they leave the country, they can get the old age security pension, but not the supplement after 6 months. The next question about non-resident speculation tax credit. The question, somebody sent me the question yesterday and asking me, I'm a Canadian citizen living outside of Canada. The question, the non-resident speculation tax, NRST, that came 2017 April, came, and the Ontario, they restricted the Golden Goshu area only, that's 15% tax. And this year, March 30th, Ontario government announced, and after the federal government did some changes, but that doesn't affect 20% of the taxes. 20% of the non-resident tax right now after March 30th. Any agreement we write after March 30th is 20% of the non-resident speculation tax in our NRST taxes. But the question is here right now. I'm a Canadian citizen living outside for last 4 years. I lost the residency status under the income tax purpose. Do I need to pay for the NRST tax if I need to buy the property in Canada? I'm going to repeat again. The question person asking me, these are residency taxes. The question asking, I'm a Canadian citizen. I'm living in Australia for last 7 years. I lost the Canadian residency status because he doesn't have any tie in Canada. The tie in Canada mean any properties, bank account, or any other investment ties in Canada. Then he lost the residency status. Then they asked me when I come back and buy the property, I lost the residency status. Do I need to pay for the non-resident speculation tax? There's a special categories are there for the income tax purpose and the non-residence tax purpose. Income tax purpose, yes, if you are leaving the country for 2 years time and you don't have any time, you don't file the international tax return, and you are losing the residency status. But for the NREC tax, extract wording I'm going to read. If a Canadian, whether living in Canada or not, buy residential land along with the properties, either the Canadian citizen or the permanent resident of Canada, or they can buy alone, not subject to NRST. As a Canadian citizen, even though they not live in Canada, they move outside, they don't need to pay for the NRST tax, guys. This is the question someone asked me, and joining with this one, I want to discuss NRST tax for another 5 minutes. NRST tax payable on top of the NRST tax. They asked me about the land transfer tax. What is the difference between the land transfer tax and NRST tax? Are they asking NRST tax we had to pay after the land transfer tax or before the land transfer tax for the value of the property? NRST tax, we are paying for the value of the property. For example, if we are buying the property for 1 million, we are going for the NRST tax 1 million, not after the land transfer tax or not after the closing statement. We are paying for the value consideration. NRST tax paying for the value consideration, same as our land transfer tax too. We don't pay the tax for the tax. In that case, they're based on the value of that one. And the next question, I am a Canadian. I'm picking this question because it's a good time to explain. The question based on the Canadian website. I'm a Canadian resident. My spouse is not a Canadian. I'm a Canadian resident. My spouse is not a Canadian. We both going to buy the property in Canada. Do I need to pay for the tax? No. The spouse is not a Canadian resident, but it's a spouse. Under the marriage category, under the matrimonial rights and the marriage category, the spouse not a Canadian resident, we don't need to pay for the non-resident speculation tax, NRST tax, we don't need to pay. But at the same time, you are buying with other partner as a friend. As a friend, you want to buy. Even though you buy, not a 50-50 percentage, even though the partner saying, they're going to have only non-resident going to put only just 1%. And 99% going to be the Canadian resident. Do they need to pay for the taxes? Yes. They had to pay for the non-resident tax, the full amount, full value. Even though the partner only going to hold just a 1% of the property, other 99% is going for the Canadian resident, still we had to pay for the non-resident tax credit for the full values. And I have other questions based on the mutual release question. Whatever happened this week in our office. Somebody asked me, he's a new agent, he made the deal and he didn't give the deposit. He made the transaction, offer, okay, he acting for the buyer and offer accepted. After offer accepted, the buyer refused to pay for the deposit. Then his question, do I need to pay for do I need to sign for the mutual release? Even though I don't give the deposit. And again, he asked, what is a mutual release? Can you explain about the mutual release? What is a mutual release? Is a mutual release signed? Am I free and clear from the full agreement? Okay. We are making the agreement or a form. For example, assume we are making the form. We are making the agreement for freehold property form 100 or condominium form 101 or commercial 500. Doesn't matter. We are making the agreement. Once we are making the agreement, the good faith money we are giving for the deposit. Another good faith is there. That's for the signing under the seal. The British old system. We are putting the red color stamp on it. That's under seal. Now, ORIA form, we can see the standard seal is a black color seal. That's under seal. We are signing it. If we are signing the purchase sale agreement, two parties, buyer and seller are both parties, they are agreeing, they are signing under the seal, for the agreement. Once they sign under the seal, whether you give the deposit or you don't give the deposit, the agreement is firm and valid agreement according to the courts. Even though you fail to give, even though Schedule B might say you don't give the deposit in 24 hours, the agreement is null and void and everything, but still your agreement is valid. They have a right to sue for if you don't close the transaction, the buyer have the right, the seller have the right to sue, even though the Schedule B saying there is no deposit for 24 hours and null and void and everything, even though we have the schedule, but still the agreement is valid. The seller have the rights to sue. In case the buyer didn't give the deposit and he after the deal firm, he signed the acceptance, he hide from you and everything, but we still have to give the mutual release. Who is the one mutual party? Buyer and the seller. Not the real estate companies, not the real estate salesperson, not the real estate brokerage. Mutual release is valid without broker of record signature. I want to repeat again. Mutual release is valid without broker of record signatures, without the salesperson signatures. The mutual release, the party of the transaction, buyer and seller. The buyer and seller sign the release is a release. Broker of record signs for the if there are any. It's inform the brokerage and cancelling the deal and all other general concept, but it's not a mandatory part for the broker of record part. But we always sign anyway. But that's not a mandatory part. But okay, if you don't sign the mutual release, you are leaving the deal open. Seller can go and sign for you. Okay, again, even though no deposit, just you have to give the mutual release and release it and free and clear. The next question. Do we need the mutual release? If there is no deposit, just you have to give the mutual release even though there is no deposit. Who gets the deposit? If there is a deposit, who gives the deposit? Buyer or seller? This is a good question. There is no deposit. There is a deposit. Who gets the deposit? Buyer or seller? Can anybody get the money? For example, yesterday I was signed. Yesterday one of our transaction. It's a double-end transaction from our Home Life Future Reality office. Double-end transaction, $40,000 deposit. The deal is firm. There's that's after the condition expiry period. That this is a firm deal. Buyer can't able to close the transaction. The buyer and seller agreed. Seller asked $100,000 to release. Then what happened? $40,000 was under our office as a trust money, and another $60,000. Buyer wanted to give it to the seller $60,000. Seller asked $60,000. Otherwise, they want to go for the lawsuit. And buyer voluntarily give another $60,000. We make the special schedule for the mutual release, saying that one the full and clear release based on the home life trust account deposit 40,000 plus additional deposit from the buyer and $100,000. Buyer give the money to the seller to release the transaction. Who get the deposit is varies. Negotiation with the buyer and seller. Negotiation with the buyer and seller, they can go sometime go 50-50. Some good sellers give 50% to the buyer and release it. Sometimes the full deposit go to the seller. And in other cases, they don't sign for the full mutual release. They sign for only the deposit. There are so many ways we handle this one. Okay. Then in this case, mutual release, buyer and seller mutually agreed and releasing it. And the next question, am I eligible for the deposit if I don't show the, sorry. Okay, there's a question for the commission question. The commission question, that's we have going through one of the court case, almost a court case right now. One of the transaction is a over 2.5 million transaction. Our salesperson didn't make the appointment. Our salesperson didn't visit the property and he made the offer. Transaction successfully closed. We are talking about around 70,000 commission plus HST. The listing company doesn't want to pay for the commission to our brokerage because he's saying our salesperson not eligible. Our salesperson not to introduce the property to the buyer. Our salesperson never take the buyer and show it. or else our salesperson under the pandemic regulation, virtual showing, he never did anything. The offer also made by the different categories. In that case, $70,000. Our salesperson looked like losing money, is going to be under the courts. Please, if the buyer look at the website and ask you, can you buy this property? The buyer property is located either Windsor, in a different area in Ontario. Make an appointment and visit. Otherwise, you have a high chance you will lose the deposit, because the deposit showing who introduced the property is eligible for the commission. Unless otherwise, if we have a buy agency agreement, and there are so many other issues there. But still, listing company and the seller can refuse to pay if the salesperson not to introduce the property. Or else, what are other cases? The same salesperson asked me, what are other cases I lose the deposit? Many cases, we didn't get the full deposit if the seller doesn't have the money. If the seller doesn't have the money, the builder went for bankruptcy. And so many cases, if they don't have money, we lose the deposit. Guys, I don't want to talk about scaring you or anything, but make sure, show the property before you make the transaction, visit, introduce the person, and you take them and show the property. And the last question, after that one, Kanna will introduce Manan, and he will come on board in a few minutes, guys. This is the last question. In case the listing company doesn't pay the commission to the buying brokerage, cooperating brokerage, who is someone going to sue the seller? Okay, for example, the commission agreement, we are signing it. Who's signing the commission agreement? Seller signing the agreement with ABC Realty, the listing company. The listing company have the rights to go after the seller. The listing agreement showing upon successfully closing the transaction, if the seller have the money, after the priorities payment means first the property taxes, if it is a condominium, paying the condominium areas, and the first mortgage, second mortgage, and those are the priorities. After the priorities, if we have the money, we will pay for the commission. This is the way the commission agreement is. In that case, the listing lawyer always giving the commission as a courtesy. If the listing lawyer doesn't give the commission, we have to go after the seller and sue for the seller. Number one. Second thing, seller, after payout, he have more mortgages and he doesn't have enough money to pay us. We will lose the commission. This happened, even many cases happened. Even our office also, we didn't give the commission to other company. The seller's mortgage is much higher than the commission. That's the reason we are keeping the deposit. The deposit money, whatever is there in the listing brokerage, they had to release that one based on the percentage, even though we don't have enough money. Who is suing the seller? Who's suing the seller? Is a listing company, listing brokerage is someone suing the seller. If the listing brokerage feel like it's not worth to sue the seller because seller doesn't have any of the properties, is not worth it, and he doesn't have the money to pay for it, listing company doesn't want to waste the time and go after the seller and sue for it. And the cooperating brokerage can request the seller, listing brokerage, to give the permission for us, and we can go after the seller to sue for it if the seller is worth it. What we do, usually we go for we pull the abstract from his name and see whether he have any other properties under the GOA house, and if he have more properties or more business or anything, we go and sue them. Other than that, if we don't get it, it's a tough game. It's hard to get it back. And please make sure you introduce a property, and you have to go and show the property rather than going for the lawsuit. Kana, that solves the questions I have this morning, and we all join together to welcome. Royal Bank, RBC Wealth Management. Manan, Kana, you go ahead.
Perfect, Manan. I see you there as well. Wonderful. Thank you, everyone, for being here on a long weekend. We have nearly 100 people on board right now, so that's amazing. So I'm very excited to have Manan on board with us. today. He is an investment advisor with RBC Wealth Management, but I would like to call him as an economist as well, because that's exactly what we're going to be discussing about today. So last week in our Zoom session, last week's Zoom meeting that we held, we discussed about the changes in the economy with inflation, rising interest rates, and how it affects the mortgage rates, which banks are, which clientele, depending on which lenders they're with, who are affected the most, and overall how it affects our real estate environment, right? So today, we're lucky to be here with Manan, or to have him on board with us, because Manan is from RBC Wealth Management, and he's going to give us a much better outlook in the macroeconomic factors and how that is affecting Toronto's real estate market as well. So Manan is a good friend of ours, our group of companies. You may have seen him at a couple of our events previously, and you'll definitely see him more going forward. He has over 10 years experience in his industry. He has a wealth of knowledge, especially in the real estate spectrum. Why? Because his family is heavily invested in the real estate side as well. So again, it's an honor, Manan. Thank you for being here on a long weekend morning. And I'm happy to say we have nearly 100 people here, looking to say what you have said.
Thank you so much, Kannan, for the very kind introduction. First of all, I would like to say, Selva Uncle, that was an incredible presentation, and it's so great to see you performing real time, because I've heard a lot of great things about you from Vivi and Kannan. And you're a legend in this industry, and your educational spirit and the passion with which you have built this practice and the culture. I can only honestly say, for me, looking out from an outside perspective into it, it is magnificent what you have built. And I want to say that it is an absolute honor to be present today and have this opportunity to speak to your team. And I hope that I'm able to add some value in this conversation. Kannan mentioned that last week, the team had an opportunity to discuss what's happening in the broader macroeconomic environment, and how interest rates and inflation are top of mind for a lot of folks in the real estate community, of course. So my goal here today is to have a more in-depth conversation about how those macroeconomic factors are influencing the real estate market. And I hope to convey my topic of discussion with the same passion with which Selva Uncle spoke to you guys today. So a couple things I want to mention before we get into the presentation. The first is that it's important to understand these macroeconomic factors, because real estate as a sector doesn't function in a silo. What I mean by that is all these other macroeconomic phenomena, what's happening with inflation, what's happening with interest rates, what's happening with household consumption, these are factors that have a direct influence in how real estate performs as an asset class and as a sector. And so my goal today, because I know all of you here in the audience, you guys are business owners, you're very successful realtors. So I want to make sure that what I'm sharing with you is usable, and it's something that will be of value to you in terms of your conversations with clients. So here's what I believe. I believe that by delivering a more enriching client experience, that directly translates into client loyalty. And one of the ways to elevate that client experience is to make sure that clients are engaged and they understand what's going on in the real estate market and broadly in the macroeconomic environment. So that's the goal. I want to share this presentation in more of a narrative story format, not so much jargon, so that whatever I'm able to share with you today with the insights that I provide, you're able to have those enriching conversations with clients. And hopefully that means longer client loyalty and retention over the long haul. So without further ado, we will move on to our first slide, and I'll give you guys what's going on in terms of the presentation format. So a couple of things we're going to cover. The first is the macroeconomic factors and how they influence the Toronto real estate market and the GTA real estate market, which I know is a focal point for all the brokers and realtors in attendance today. And the second part we're going to capture is then the health of the real estate market, how all those factors have collided and come together to have an impact on Toronto and broadly what trends we see in Canada as well. So a couple things here. The first is, I know that inflation is top of mind for everybody. It's the trending word of the year, I suppose, this year. And we're going to look at how inflation is going to be impacting the economy broadly, as well as individual households. Next, we're going to see how the interest rate environment has changed because inflation is top of mind and needs to be tackled, and what actions central banks are taking to deal with it. And then thereafter, we're going to see the implications that these two things, inflation and interest rates, are going to have forward-looking in terms of economic growth and household consumptions. What does that mean for everyday households in the broader economy? Next, we're going to move forward and really study what these factors are doing to the real estate market specifically. And obviously, one of the major topics we're going to cover is the structural shift in buying power because mortgage rates have gone up, as you all know. The other factors we're going to touch upon in greater detail is the real estate supply and demand dynamics, what's going on in terms of the supply and demand equation in the Toronto market. And finally, after all of those things are addressed in greater detail, we're going to look at what's going on with sales and prices, of course. So I'll move on to the first slide. And this is sort of going to discuss the history of inflation. Now, I know all of you, this is not something new to anybody. Everyone's been talking about inflation. And like I said, I want to make this a more story format conversation. So when you look at this chart, the first thing I want you to notice is that inflation isn't a phenomenon exclusive to Canada. This is actually going on in developed markets around the world. So we can look at Canada, US, the Eurozone, as well as the UK experiencing the same phenomena. What I would like to point out in this particular chart first is if you look from 2016 onward to 2020, the first thing you'll notice is that inflation has been quite anemic, pretty low, 2% or below for the last several years. And then prior to that, if you go back even a decade, you can see that inflation has been quite subdued. Now, when you look into that particular graph, you'll notice that 2020, of course, we experienced a rare black swan event, the global pandemic, once in 100-year type of event. And you can see right there what happened to inflation. And what I want to share with you here is in a format so you can have the conversation with clients. So if a lot of clients today are asking their brokers to understand what's going on in real estate, what's happening broadly in the macroeconomic environment. And so when you look at inflation, let's discuss how we got here. How did we get to 8% inflation, 40-year record in terms of how high inflation is? How did we get here? And so to understand that, let's rewind. Let's go back in time and look back at what happened at the beginning of the pandemic. So all of a sudden, if you look at what happened in 2020 in the chart, pandemic hits, the economy comes to a bit of a standstill because people are now a little bit afraid to consume. They're selling in the stock market. They're generally concerned about what's going to happen in the broader environment going forward. And so in those types of environments, that's when we have the two key pillars of our economy step in as an emergency measure. So you had the central bank and you had, of course, the government step in. So we had two parties step in to save the economy. And both entities have different goals and different tools in their arsenal to help the economy. So when it comes to the central bank, the main tools that they have are interest rates, and they have some additional tools, quantitative easing, which really means money printing, but I'll get to that. And when it comes to the government of Canada, the tools they really have is the ability to spend into the economy to help the economy, which we call fiscal stimulus. So we have from the central bank monetary stimulus and from the government of Canada, fiscal stimulus. So when the emergency hit and the economy was at a standstill, they had to act. They had to do something to revive the economy. And the central bank, as you know, acted right away. So the first thing they did, as you all may recall, is they cut interest rates. So for the last couple of years, we had rock bottom interest rates. And the second thing that they did is they started to do something called quantitative easing, which in this case means printing money, Canadian dollars or US dollars, whichever economy you're in, and pumping that into the economy to stimulate the economic activity. The government of Canada, what initiative they took is they started to do stimulus packages, which is what they're mandated to do. Now, the combination of those factors, what did that do? Well, first of all, when you cut interest rates and hit rock bottom, what happens is now businesses and households can borrow at a very reduced rate. which tends to be very stimulative for the economy. And what did we see? We saw the housing market go up, generational type of gains for 2 years. We saw stock markets go up, bond markets go up, alternative markets go up. So asset classes under the sun, all asset classes, we saw incredible performance for the last 2 years. And from the fiscal side, again, that was stimulative because they were able to spend money, borrow, but spend money today to help a lot of the economy survive this pandemic shock. And that had the same impact. So we had a lot of fiscal checks to people who needed it, and it did help them, but it also pumped more money into the economy. So when you pump all this money to the economy from the central bank, as well as from the government of Canada, and you have rock bottom interest rates, historically speaking, anytime you have that sort of combination of phenomena working together, that tends to boost asset prices across the board. And that is what we saw. And this wasn't just in Canada, because Canada, US, UK, Eurozone, and many other developed nations from around the world, like Japan, embarked on the same type of policy and similar types of outcomes across the board. So that's where we are today. If you look at that right-hand side of the chart, you can see what happens when there's a lot of demand for things and people have a lot of capital to spend in the economy. And the final part, which is the supply shock. So as we all know, one of the things that happened during the pandemic is around the world, we had supply chain shortages. We had companies shutting down around the world. We had slowdowns around the world. And what did that do? Well, it reduced the supply of things, goods as well as services. And when you have a reduction of goods and services, but a tremendous demand, but very few supply of goods and services, that's what causes prices to rise. And inflation, if I were to sort of define it like Selvankel does for all of you when he discusses concepts, inflation is the general rising of prices of things. And the biggest components that make up inflation are food, energy, shelter, and wages. Okay, so now we're going to go on to the next slide. And I'm really going to focus in on the Canadian situation that we're experiencing here. So again, first thing I want you to look at the chart here, and I'm going to point out a few things. So if you look back, last couple of years, as you can note, inflation was quite anemic and subdued, on 2%, really within the target of the central bank. The central bank's goal is to keep it between 1% and 3%. And it's been doing that for about a decade if I go further back. And what you'll note here is there was a pause, obviously, in the middle during 2020 because everything kind of shut down. And then you can see with all these policies, the prices of things rising. And there's a couple things here. The foreign component here, which is the yellow part of the bar graph, really coming from the imports from abroad. So food as well as energy are the biggest drivers. You can see the home buying having a big impact, which actually didn't have in the last several years. If you look at the chart, the blue part, the light blue part of the chart, because home buying obviously picked up. When you have low interest rates and a lot of money in the economy, people want to buy houses because they're actually being incentivized by the banks to borrow and buy homes. And that's exactly what they did. So that obviously went up, as you all know. It was a great 2 years, and that contributed to inflation. And finally, everything other than home buying as the last piece. And you can see goods, other effect, even used cars, guys. Shockingly, used cars were up. So it just gives you an idea. Depreciating asset like used cars were up just because people had so much liquidity in the system. So what does this all mean for households? That's the big question, because your clients are going to understand. They want to understand really what this means. And so if you think about a household, imagine I have a particular budget, and now some of the basic things I have as part of my living necessities have gone up in price. So food is up, energy's up, my shelter expenses are up. What does that mean? If I have a budget like this and I'm now all of a sudden these basic necessities are taking up more of my budget and I have less money to go out and shop and consume. So that's the first thing I want you to keep in mind. This is what inflation does. It eats away at our budget. And if I were to sort of present it as, if you think about the economy and society as having different income spectrums, so you have upper income, middle income, lower income. The unfortunate thing is the lower income families are hit the hardest when inflation's rising, because the cost of living goes up really dramatically. Like I said, food, energy, shelter are the biggest for them. And so this is why central banks as an institution, their number one priority, stated goal as a mandate for an institution is to make sure price stability is achieved. What does that mean? It means keeping inflation between 1% and 3%. And do we have that today? We do not. It's at 8%. So let's go on to the next chart. And we can really see what central banks have had to do in terms of addressing this, 8%, 4x growth in inflation over a span of just a year, in fact. So a couple things I want to point out. So if you look at April 2020 on the left-hand bottom part of the chart to February of 2022, rock bottom interest rates. It was there intentionally to make sure the economy stays stimulated because during a pandemic, when consumption is slowing down, you want to keep interest rates low. And obviously all those, the quantitative easing and the fiscal stimulus got people spending and got the economy pretty hot. So when the economy got that hot and inflation is 8%, the main tool the central bank has is interest rates. And what did they do? They started to increase interest rates. And you can see, and I'm sure all of you are following that very closely because it's very important to the real estate market, how quickly, so I want to point out how quickly the rise in interest rates have taken place. So from March of this year to now, it's gone up quite substantially, just like inflation has. And just like when interest rates were cut, it was stimulated for the economy. The reverse is taking place now, which is this is slowing down demand in the economy. Okay, so that was the goal of central banks. They want to bring inflation down because here's the problem with inflation. This year, 1 year of inflation, not a big deal. But imagine if inflation stayed at 7% every year for a decade, then your cost of living would double. And that's what central banks want to avoid. They do not want the cost of living to double for families around the country. And that's why it's such an important mandate for central banks. So I want to point out an additional factor here, because I already mentioned in the previous chart that a family has a budget, and with inflation, more of that budget is being eaten up by food, energy, and shelter. Well, let's add another piece to that now. Well, we know now that interest rates have gone up to deal with inflation specifically. And when that took place, now you see debt servicing for a family's budget has also begun to increase. What I mean by that is, if you look at mortgages, if you look at home lines of credit, if you look at auto loans, loans across the board are priced using this central bank rate. And so they have gone up. So now if you have a budget, some part is being eaten up by the higher cost of living, and now a little bit more is eaten up by higher cost of debt servicing, okay? So as a result, again, less money left to go shopping, less money left to go out and consume, which is what, and remember this, when I and others go shopping and buy things and consume, that's income for another business. If I go to the mall and shop, all those retailers at the mall are making money and they're business owners. So that's good business for them. If I go to the store and eat and go to the restaurants, that's good business for them because I'm out there shopping and spending. And when, as a collection, as a population, we don't do that, now there's less income for business owners as well. So it's a ripple effect. If we consume less, there's less income for the people we consume from, and this sort of creates this ripple effect. And the final piece I want to bring here, and I mentioned to you guys that there was sort of this, if you look at the income spectrum within society, you have high income earners, middle income earners, and low income earners. So what happened is, if you think back, and let's look at the middle and higher income portion of the population now. At the beginning of the pandemic, when things were going up in price and interest rates were low, we had something called the positive wealth effect. What is the positive wealth effect? What that means is, when you look at your statements, and let's say you have real estate, you have stocks and bonds, and you have alternative assets, and you see all those things going up in value. So your stock portfolio is up, your bond portfolio is up, your real estate equity is up, everything is up. It feels really good. Okay, it feels really good. In economics, we call this the positive wealth effect. And when everything is good, and you see, hey, I'm doing great, my net worth is up, you're more inclined to go out and shop. And we saw what that did to prices and inflation. The reverse is taking place now. What you have to understand is interest rates are like gravity for the economy. When they go up, all assets tend to come down for different reasons. Stocks and bonds, I won't get into the reasons why they come down, but it's to do with valuation. So stocks come down, bonds come down. And real estate, all of you know, is to do with mortgage rates. And that's what caused it to sort of go through a period of pause. But the key thing to keep in mind here is that now we're having something called a negative wealth effect, which is we look at our balance sheets, stocks are down, my bond portfolio is down, my real estate portfolio seems to be gyrating. So I'm not willing to shop as much as before. Okay. So what does all this mean? So we talked about the budget. We talked about increasing cost of living, increasing debt servicing, less money to go and shop and consume, and also negative wealth effect. If we go to the next chart, we will see what all this means. And if you look at the next chart, it's actually to do with GDP consumption. So a couple things I want to mention here before we get to that chart, I guess. So, interest rates, like I said, have a big role to play. And we're going to talk about what all this means also for the real estate market, which is going to be the core part of the next part of the presentation. So if you go to the next chart over, perfect. So over here, like I had mentioned, when you have less money with which to consume, and we look at collectively for all Canadians, we can see based on our projections from RBC that we're going to see a reduction in household consumption. So that light blue, the middle dark blue actually is household consumption. You can see that over the coming quarters, we see a downtrend on that. And it's to do with the fact that everything I've mentioned, which is there's a slowdown in household spending, and that's going to definitely weigh on growth realistically. And the key thing to keep in mind, if you look at that GDP line, which is the line in yellow, the GDP represents the output of the economy as a whole. And when you have a drop in consumption, which we're expecting we're going to see in the next quarters, we should see a drop in GDP. And the good thing about this is the current expectation is that it's going to be short-lived. And if you look at Q2 of 2023 and Q3 of 2023, that's when you see the two contractions that we're going to have in the Canadian economy, as predicted by our RBC economics forecasts. And right after that, we should be bouncing back. So the key thing I want you guys to keep in mind as we move on to the next part of the conversation is, the reason interest rates are going up is really all about inflation right now. We haven't had inflation like this in 40 years. It's been forever. People don't even remember. I wasn't even born. So the point, and a lot of, who are younger here, haven't ever experienced this. So the idea here is central banks know when you increase interest rates that other asset classes will be impacted, but they also know that they can't have cost of living unchecked because that's going to cause long-term damage. So they're increasing interest rates knowing that all these asset classes, stocks, bonds, real estate will go through a period of adjusting. And that's a price we rather pay today than have to pay for the next 5 years. We rather deal with it today, get it figured out, have it addressed in a year or two, and then rebound rapidly and set the market up for the next good 10 years, as opposed to not do anything today and have this problem prolonged. So that's the approach they have taken. So if we move on to the next chart, we're going to see, this is to me one of the most interesting charts I'm going to share with you guys today. And what it's really sharing here is what's going on with inflation. So the idea is this: inflation's at 8%. Normally it's supposed to be at 2. It's 4x. Interest rates are going up to deal with inflation. Now, when inflation begins to show signs that it's peaking and it's beginning to come down again, because that's the goal of interest rates. When you increase interest rates, the goal is inflation will start to come down. Okay. So when inflation begins to come down, that's when central banks will say, okay, we can take a pause now and we can start cutting interest rates again because the economy inflation's coming down. We have achieved our target. So what this chart is showing you is what is the evidence that we see that inflation is beginning to turn lower, that the interest rates are actually working and inflation is in fact turning. Well, at this stage, we're still early, but thankfully we're starting to see a little bit of green. We have had a couple interest rate hikes, as you know. So, when it comes to pandemic boom goods, starting to come down a little bit in terms of the inflation expectations, which I'll talk about briefly, is starting to come down. It's mostly no and maybe because we're still in the very early stages of the hiking cycle. Okay, still no and maybe, but we hope that, keep in mind, interest rates don't work right away. It typically takes between 6 to 12 months to really see the impact of interest rates to work themselves through the economy. And we believe that as it works itself through the economy, we're going to see more and more things on the green side and on the yellow side. So yes and maybe. And as soon as we start to see that, and RBC is tracking this, this is one of the advantages of being in the banking ecosystem. We track this for all sectors of the economy. But when we see that, hey, more and more signs are showing that inflation is turning, that's when we're going to know that, hey, they're going to pause on interest rate hikes and interest rate cuts may be coming in the horizon. So interest rate in expectations, I'll just briefly touch on here. One of the very devious elements of inflation is that not only does it increase the cost of living, but it causes people, the businesses and households, to expect inflation to continue. And we can't have that because it's almost a self-fulfilling prophecy. When people expect prices of things to be rising, they cause it to rise. When businesses expect to keep raising prices for their consumers, inflation expectations cause it to rise. So one of the key goals of interest rate hiking is to make sure people's expectations are taken care of right away. You want to break that inflation expectation psychology so that it doesn't get sticky in the economy, meaning it doesn't continue in the economy. Okay, so lot there. Let's go into the real estate market now. I think that's the core focus. That's why we're all here. Let's understand, if you go to the next chart, what does this all mean for the real estate market? Well, the first thing I'll mention here is, yes, we have seen a slowdown in real estate, and it's to no one's surprise. You guys are all industry experts in this chart. This basically shows you Canada's month over month. I want to point out how many good months we've had. Look at it. Look at that chart from 2020 to now. Until recently, every single month, positive month over month gains, exceptional. One of the best asset classes you could have been in, and I will talk about it later, that you should be in for the very long term as well. So recently, obviously with interest rates, it's begun to come down. And if you look at the right-hand side of the chart, you can see that clearly. If you go to the next chart, before we get into why we're experiencing this, let's talk a little bit about the mortgage side of the business. And I think it's really important to tackle that side of the business because that's having a direct impact on the sale and price side. So on the real estate front. So the first thing, this chart, I just want to bring it to your attention because a couple things here. The first is you can see the Bank of Canada rate is directly linked to the variable rate mortgage. And the most important part of this chart is it's to no one's surprise, the Bank of Canada has been hiking rates and variable rates have been rising. Okay, so the key theme in this chart is variable rates have taken a jump. And what does that mean? That means the cost of buying a property has gone up. So next chart, I'll do the same thing for the fixed market. So if you look at the fixed, 5-year fixed, the 5-year fixed, and it's a little bit different than what we use to assess the variable market. So Kanan, if you go to the next slide. Perfect. So the 5-year fixed, again, what is the conclusion of this chart? The conclusion is, well, look at that. The 5-year bond yield is up, and with that, the 5-year fixed is up. So just to give you guys an understanding of why we use the 5-year bond yield and the 5-year fixed. So the idea here is it's all connected back to that central bank interest rate, no question about it. The 5-year bond yield is actually also connected to the central bank interest rate. The only difference is the 5-year bond yield, the bond market is pretty smart. So instead of pricing what's going to happen with central banks, it likes to look forward and expect what central banks will do in the future, and it will adjust today. So we can see, obviously, the 5-year bond yield has gone up. And usually, if you look at all the big banks and all the different firms, we use the 5-year bond yield to do the pricing for the 5-year fixed mortgage. So just like the 5-year bond yield has risen, so has the 5-year mortgage. And sometimes you'll note, and this is so for your curiosity, that even before a central bank hike, you'll note that the fixed 5-year is going up. And the reason for that is this, which is we use the 5-year bond rate to come up with the 5-year price. And the bond rate sometimes move in advance of the central bank rate because they're assuming what's coming and they already price it in. And that's why the banks do it in advance of the overnight rate. So again, the two main points in these two charts is, guys, the mortgage rates have gone up. The cost of borrowing has gone up. What does this mean for real estate? Well, imagine early part of the pandemic, you had an income of $200,000. And that $200,000 at rock bottom interest rates was giving you a buying power of $800,000. Now, fast forward to 2022. You have the same $200,000 income, but mortgage rates are up. Now you maybe only qualify for $600,000. Same income, but because higher rates, you qualify for less. So less buying power, which puts a structural ceiling on the market, meaning now buyers can't go out and bid it up like we did in January and February of this year, and many parts of the rest, like in 2021, because they can't. They're not getting the buying power to bid things up, which is why if you go to the next chart, we can see what's happening to the sales to new listings ratio in Canada. So I will just briefly touch on this. All of you are experts, you know what this means, but I'm just gonna quickly explain it for those who want to understand what's going on here. So as you know, this is a very important ratio for all folks in real estate. And what it's showing is for, let's say every 100 listings, if we have sales of 60 to 80 units, so let's say 100 new listings come on, if anything above 60 gets sold, we're considered in a seller's market. So 60 to 100 seller's market. Between 60 and 40, so 60 and 40 were sold of every 100 new units, we're in a balanced market, which we're in now. And finally, if it's below 40, we're in a buyer's market. So what you'll note, two things. The first is we had a seller's market for the last 2 years, as you all know. It's been a great ride. It's been amazing. And it's been generational type of return. So I'm happy to say that everyone who's been invested in real estate has done amazing. But at the same time, now we can see how with interest rates going up, we're turning into more of a balanced market, okay, from a seller's market. Sellers no longer have that control that they had for 2 years because there was so much demand. Now we have a pause because structurally mortgage rates are higher and buyers are sort of a little bit of a pause trying to assess what's going on with inflation, interest rates, etc. So we see that now sellers are no longer in control as much and buyers are starting to see good deals again. And we can start actually having clauses. You can put in the conditions into your contract again. No conditions for 2 years. Now you can have conditions again. So that's nice. So if you're a buyer, there are opportunities now. And we can see that the market in Canada is sort of coming down more towards the historical average. So that's the other thing to keep in mind. It's normally supposed to be balanced and it's returning to that. So if you go to the next chart, this is to no one's surprise. Everyone's aware of this. You guys all follow Treb. You guys all use MLS all the time. You can see that the home resales in Canada have come down. And that's because, like I said, it was coming down from a record level, right? So you're just returning sort of the historical norm more than anything. And that's what this chart just shows. It just shows that all those things in combination, what is that doing to the resales? So if you go to the next chart, let's speak to Toronto. Because I think this is something, you guys all work in the Toronto GTA market. This is important for everybody. And I want to make sure that I just touch upon a few things from last month's update, which is the most recent, because we're going to get the data from Treb in 5 to 6 days with the latest updates for July, of course. So a couple of things I want to point out. The first is if you look at the so home resales, year over year, significant drop in resales because we had a record number last year in 2021. So if you're coming down from a record number, even if you come down to the average, it looks like a huge reduction, but we're just returning to normal. That's the first thing. If you look at new listings, well, it's to no one's surprise, new listings are going up and sales are coming down. On the month over month side, you can see that. And what does that mean? Well, we looked at in the previous charts, the sales to new listings ratio, and you can see for Toronto, it's 0.44, which means we're just hovering above the buyer's market. So we are in a balanced market. So for the first time in many years, in 2 years, people can actually, again, look at deals to be had in real estate. If you're trying to hold for 10 years, longer, 5-10 years for your clients, a great entry point now to consider for some clients who are okay with the current borrowing costs. And I'll just speak to finally the MLS Home Price Index for Toronto. Yes, year over year, we're still up, guys. We're still up 17.9%, which is phenomenal. And it's also on the list above Canada, because Toronto's always had a little bit of a premium on Canada because we are the best, better than Vancouver, so best in Canada, I would like to say. And yes, the month over month is coming down. So you can see the monthly data showing, yes, we had a really high level in Jan and Feb of this year. So from that level, we are coming down, but still from last year, we're still up. So that's the positive to take from here. So if you go to the next chart, I just want to broadly talk about what's going on in our province, because you guys, you're all licensed with ORIA, you're licensed in Ontario, and within Ontario, Toronto obviously is the core market. But I'll just speak to this broadly. If you look at the long-term average, so I want you to take your attention. If you look at Ontario and you look at how many sales we've had on average, it's around 220,000 on average. Okay, and this year, we're down on sales, and next year in the forecast, if you look at 2022 forecast and 2023 forecast, you can see that we're going to be coming down in terms of number of sales, and it's to no one's surprise because the mortgage market, the actual interest rates are up, so there's going to be a little bit of a pause, and builders are seeing this too. So there's going to be a pause on the construction side too. But the point here is that in the long run, we will return to the average of 220, which is the historical average. And markets, this is something that's common across all markets, which is that over the long term, we tend to return to the historical averages. And in this case, the historical average is 220. And so, when it goes to 167 next year, there's nothing to worry about, because what that means is the market, after 2 years of incredible gains, is going to take a pause. And it's actually healthy for the market. And we'll talk about that in the next slide. So if you go to the next slide, this is very similar to the next slide, but we're going to talk about the price. And this is important for everybody to keep in mind. So like I said, I expect from 167 in the long run, we're going to return to 220 because that's what markets do. It's the same for price. Okay. And here's what I want to really point out here. Look at Ontario in 2014. 423,000 was the average price. And look at today, 2.5x by 2022 and 950 plus. I mean, those types of gains are hard to come by in any market. So first thing to keep in mind, Toronto real estate, GTA real estate, one of the best investments globally, because we are with the rest of the top markets like the Singapores, the Hong Kongs, the New Yorks, the Londons of the world. We are one of the top tier metropolitan cities. And if you look at the price, if you look at the average of that price, it's typically around 7%, okay, on average. And the last couple of years, it's been a little bit better. This is Ontario, and Toronto is a little bit better than that. Toronto is about 7 to 10%. And what I want to point out here is look at 2020 and 2021, 12%, followed by another compounding of 22 plus percent. That is way outside the norm, which has been amazing for everybody in real estate, right? If you're in real estate, you own properties, your equity is up in your investment property, in your principal home, it's up and it feels good. Your clients are happy. But what you have to remember is clients, we're all in an economy that's evolving. And I do believe that, that type of price growth of 12%, 20% every year, it's not sustainable. It's realistically, if you look back at history, and it's not healthy either in the long term. And so in a way, this correction that we're beginning to have now, it's actually good. So number one, it's good for buyers because they haven't had an opportunity. And number two, it's good for the long-term health of the market because this will basically be a pause. We had a really up gain, bit of a pause, maybe a bit of a correction. We don't know yet. We'll see next year. And then what it does do is now the price, if you look at that last forecast around 880, it's setting us up to have a really good decade. And so when you're talking to your clients, it's setting us up to have that healthy 5, 7, 10% for the next decade. And that's what you want. Even if you take a pause, you're still up. And so now I'm going to go to the final chart of the presentation, and I'm going to bring everything home. So in this chart, yes, on the right-hand side, you can see that, yes, a bit of a downshift we're having at this stage. But I want to bring your attention from February 2020 to February of 2022. My goodness, look at that price gain. So everything from the beginning of time till 2020 February, let's say that equals 100 in terms of the value of a city. Let's say Toronto is the yellow line. In 2 years, we went from 100% to almost 150%. Generational type of gains. Generational. So if your clients have invested, they've done so well. They're well off. They're feeling great. So what I want you to keep in mind is as you educate your clients and make sure you're providing them all the up-to-date information and keeping them up to date with the latest data and markets, I want you to keep in mind that it's your responsibility to remind them, look at those gains for 2 years. If we had normal markets, it should have been, from 100, it should have gone to 107 on the MLS and then 115 in 2 years. Let's say historically, we're at 150. So even if you come down from 150 a little bit, you're still up. What I mean by that is in 2 years, if someone made 50%, that's way more than the annual 7% per year, which is historically normal. So even if, let's say, this market goes through a flat period, like this year, 1 year of flatness, or maybe even 1.5 or 2 years, do you think your clients are going to complain if they made 50% in 2 years or 50% in 3 years or 4 years? They're still making more than 7% annually compounded. So this chart basically highlights, yes, we're in a bit of a pause, but we've made a lot of great gains. And I want to sort of keep that as the main focus. And I want to share 2 things. This is the thoughts I have about the long-term growth of Toronto. And I'll share 2 thoughts here because I love Toronto. And I want to share, in terms of the real estate market, couple unique things about Toronto as a city. The first is this. Toronto is one of those global destinations where we have organic migration into this city, which is rare. Not many places have this unique phenomena, okay? And that's one part of demand. So I'll call that external demand, okay? That we have that's unique to Toronto and the GTA. And number 2 is that we have a very healthy local economy. So, big 5 banks, big 4 accounting firms, great real estate firms, 3rd largest tech city in North America. What does that all mean? That means that the locals who live in Toronto and the GTA have good jobs and good incomes. So you have external demand from people coming from abroad who love Toronto, one of the best cities in the world, and internal demand, which is great jobs, really healthy population who have the ability to keep consuming. So when you have that great demand side, and you have limited supply, and we all know about the limited supply in real estate, and it's going to continue. What it does do is we have the equation that's really beneficial. Low supply, lots of demand for the next decade to come. Okay, so I want to sort of share that with you. So keep that in mind as you're educating clients about the future, that you want to think about Toronto as a long-term investment so that you're able to double your investment, triple your investment over the long horizon. And that's what clients should be doing as they're thinking about markets. So I hope that I was able to give you a different angle coming from the bank side. And I hope that some of this information was of value to you. So, I'll leave that here. My role is I'm an investment advisor with RBC Wealth Management. I build portfolios for clients. And my job is to make sure I'm on top of all the economic developments so I can build the best portfolios for clients. So I won't spend too much time here. I know Kannan, Selvankel, Vivi, they all have my information. So I want to be able to at least address some questions from you guys. So let's move on to the next slide. And I'd love to take any final questions. So yeah, so here we are. And thank you guys for the time. I really appreciate this opportunity once again.
All right, thank you. So, I'm telling you, you touched on all the points that is well needed for us, especially with the recent discussions we've been having regarding our economy. So thank you for that, and I'm sure Selvana's. I've seen Selvana smile quite a few times throughout this presentation as well, especially when you mentioned that real estate is an asset class that you should be heavily and continuously involved in, especially for the long term, regardless of the drop in the market right now, regardless as an asset class, generational wealth, which is something that Selvana has always been promoting and pushing to everyone to have the most beautiful future, successfully, financially successful future. So, Uncle, I'm sure you have a few things to say.
Definitely, Manan, whatever you said, we are in the best asset class. That's the reason I started to teach real estate. I always tell them, we want to sell something rather than selling the dollar store stuff or the vehicle stuff. We have to go to the high-end stuff. Everybody's high asset real estate. That's the reason we are here selling the real estate industry. This is an amazing seminar, and you gave us a really good points. the very valid point, the clients supposed to understand year 2020 February to until now 50% or more than 50% growth. In that case, the paper money come down less. We're not going to lose anything. Nobody going to lose anything. Ontarians are real estate rich right now. Ontarians have become millionaires from the real estate industry. You touch the right point, man, and I really appreciate your time and everything. But we need more of your help. You are the wealth management person. We need the wealth about the asset freeze for the real estate, our asset and the family trust, to how to move the asset from now and the estate plannings. And if we are in that field, definitely within 3 months we had to meet you again in the Zoom, and you had to give us, because our real estate agents having, most of them having 3-4 houses or more, then they need to learn the estate planning and some of the asset freeze and those kind of things. Maybe you can help us out.
Absolutely.
I think Vivi is ready to talk to you a few minutes. You are Vivi's friend and he's ready to talk to you a few minutes. Go ahead, Vivi. After that, but I have a few questions. Real estate, some agents send me about the gas station question. I'll continue after that. Vivi, you go ahead.
Yeah, actually, there was a question in the chat line asking if there was any anticipation for another rate hike, and for sure by the end of this year, I think all of us agree there definitely is going to be one. Just to get that question out of the way, but Manan, thank you so much. I know we reconnected after many years, and it's amazing to see a childhood friend come to this level, and I'm so happy that you were able to share with us your insight from a macroeconomic standpoint. We'll do this again sometime. And for all the other agents, if you guys have feedback, please, by all means, send them to myself, Salvana, or Kenan, and we'll definitely look into it, see if there's any other kind of seminars that we can put together. Outside of that, thank you.
I'm definitely sure that, Manan, this is not going to be your first and last seminar with us. We're going to definitely have you on board. Salvana brought up a very good point with generational wealth and how to manage your finances, especially within real estate, and how to pass them down with the least tax effective methods. I know there's a couple of more questions. Feel free for everyone to unmute yourself. I know, Sony, you just wrote down a question there as well. Thank you for that. Delano, you had your hand up. So gentlemen, free feel to ask any questions. Just unmute yourself. And then Salvana will go into talking about a few other questions that he wants to address as well. Yes.
Hi, Manan. Can you hear me?
Yes, I can hear you.
Thank you for your presentation. Very clear, very concise. We appreciate the tools that are there available for us. I suppose everything was left to the central bank, considering that the federal government almost went to sleep for a while this rise was going up, and then suddenly everyone woke up and someone had to pay the bill. And it was left up to the central bank. So this was probably one of the major financial tools that they had with the quickest results. We see the forecast. Thank you for that forecast. This is all done for a better future. It's not done for this continuous shock in the market. I mean, it is there, but I think it's done for a better future. I think it's done for a better Canada all around. It's going to be a period of adjustment, not just for our clients, but for us as well, as the way we describe and sell and buy properties for our clients. But change is good. Change is good. It's a good time for this to happen. It's a time when it's happening when everything is healthy, as opposed to it happening at a time when it's too late to do anything at all, right? So they came in fast. It's something that we have to educate ourselves on. Do you see, my question is, now that you see the real estate market taking a hit, do you see the liquid capital and liquid cash going into other aspects of the financial market? Do they going into bonds now, or long-term investments? Are they buying stocks? I know energy took a hit, obviously. So is it going into other asset classes?
Yeah, I can certainly speak to other asset classes because that's my day job. I'm a portfolio manager, and I build portfolios for clients. So the difference, and thank you, Delano, first of all, for the question. I appreciate it. So in a way, if you think about stocks and the bond market, the difference between them and the real estate market is they tend to be forward looking. So what will happen is stock and bond markets will look into the future. They will anticipate what's happening or what's going to come in 6 months or 12 months. and they'll reprice today. So what I mean by that is in January of this year, the stock and bond market already forecasted that, hey, inflation is going to be high. And as a result, interest rates will have to be increased by the central banks. And because they already foresaw that, they got adjusted from January because they adjust in advance of it actually happening. So that's one thing. The stock and bond markets are leading in that sense. The real estate market is a little bit different. Because mortgage rates are what affects the real estate market, it actually shows the impact a little bit later. So what I mean by that is we won't see the full impact of interest rates until next year because it takes about 6 to 12 months for it to work itself through the real estate markets via mortgages, okay? To your question, because stock and bond markets have already corrected quite a bit this year, there is obviously a certain demand that's going into that market because there's good valuations in some areas if you look. But keep this in mind. So the dynamics of real estate are very localized, as you all know. So we're looking at the dynamics of Toronto or GTA or Vancouver, and it's different. Montreal, it's different. It's dependent on the supply of property in Toronto and the demand for Toronto real estate. And I would say Toronto and GTA are, one of a kind in that sense. And so what I will say to, the question that you asked after sharing that backdrop is, it is important to keep in mind that the demand for real estate is different for stocks and bonds. So if you're growing, real estate, it's not just about growing your wealth. Of course, it's one of the best asset classes to grow your wealth, but it also has a utility because you live in your real estate. Your kids go to school. So real estate has a utility. You have to use that asset too. So it has a dual benefit, utility, plus it can give you a lot of wealth over time. So the demand, if you look at the home ownership rate in Canada, it's quite high, and I expect it to stay high. And millennials as a cohort, it's a huge demographic. It's actually the largest group of people as a demographic cohort since baby boomers, okay? And it's the largest in history. And that cohort is right now in the early stages of their working years. So the average millennial is about 31. And they will tend to consume for the next 20 years because that's their peak working years. And they're going to be consuming big ticket items like real estate, furniture, all those, cars, etc. And so the demand for real estate will be coming from other sides. And I do think that, yes, the people are adding to other asset classes like stocks and bonds. And I won't speak to that too much here, but I will speak to the fact that the demand for real estate, if you're a long-term investor, that's the key word here. If you're the long-term investor, I'll share with you how one thought about the benefit of real estate that other assets don't have, which is leverage, okay? It amplifies return. So let's just say it's $1 million property. I pay 20% down, that's 200,000, and I'm getting 800,000 from the bank to buy it, okay? Let's say next year, that $1 million property goes to 1.1, up 10%. On my 200,000, that 100,000 is actually 50%, okay? And that's because I had a leverage of 5. 200,000 I put in, 800,000 I got from the bank as a mortgage. So if it goes up 10% to 1.1 on my $200,000 investment, so 100,000 divided by 200,000, my return is 50%. So I took 10% and I multiplied it by a leverage factor of 5 to get to 50%. That phenomena in real estate, whatever your leverage is, maybe it's 50-50 LTV or 30-40 LTV, whatever your LTV is, that's the power of real estate. Because yes, you're contributing your investment and the bank's giving you some power as well, which amplifies your return in real estate, which is why I think real estate, because Toronto is a pretty long-term safe market, if you have a 10-year horizon, it's going to be hard to beat the returns because of the leverage factor in real estate. So while I do think it's a good, stock markets and bond markets are becoming more attractive, I think real estate is still going to be, especially Toronto and GTA real estate, will be a staple in portfolios for clients. Thank you so much for the question.
Perfect. Manan, I had a quick question as well. Now, you touched up on the topic of the 5-year fixed rates and how it's driven by the bond market and how the bond market's outlook is 6 to, let's just say 12 months ahead when they're forecasting of the changes that they're implementing right now. There's been a lot of chatter within the Twitter financial world about bond markets decreasing fairly soon, and also the potential 5-year fixed rates to drop. And there's been chatter within amongst a large real estate community and also the mortgage community, how they're expecting 150 basis point drop in the next, let's just say, 12 months for the 5-year fix. 5-year fix is sitting at, let's just say, around 5.49 approximately. So they're expecting something within the high 3s or mid 4s. How likely do you think that is? Also, based on one of your charts, I believe the 5-year, the bond rates projected for 2023 was going to start to decrease. So any inputs on that?
Absolutely. And thank you for that incredible question, Kannan. So a couple things here I'll mention. Yes, the bond market is future forward looking, meaning looking at 6-12 months and adjusting today. So what's happening is there's a corner of the market that believes that inflation will begin to turn more rapidly because a lot of the interest rate increases have been front loaded, meaning they're happening now. They've already been happening since March. Okay. If those interest rates are effective and it turns inflation down, okay, that's what central banks are looking for, to see if inflation's coming down. If inflation's coming down, then they can start to pause. First, they're going to pause on interest rates. Then if they say, okay, inflation is coming down quite dramatically, and I showed you that chart that had all the indicators about how far we are in terms of the inflation turning, remember that? So right now we're pretty early, but if inflation does indeed come down, first they'll pause interest rates and then they'll start to cut interest rates. And in fact, the forecast for the market is next year at some point, second half of next year, they may be cutting interest rates. Now, with that said, I can attach a certain probability to that outcome. Like it's not certain, it's the future. Last year, the Federal Reserve told us inflation was going to be transitory. It wasn't. And they're the institution with the best data in the world. It wasn't. We have 8% inflation. So what I will say is everyone now, we're looking at all the data, we're trying to understand it, we're attaching probabilities to the outcomes, but no one has a crystal ball. And that's the reality. So that's just the nature of the work we're in. But we can study with certain degrees of probability what's likely. And there is a corner of the market that does believe that next year, if inflation comes down, they might start cutting interest rates. And if they do, remember the bond market is in advance. So bond market will see this 6 months in advance. And the 5-year bond yield, track it will come down before they start to cut interest rates. So that'll be your signal that, hey, interest rate cuts may be on the horizon, inflation is coming down. And then the 5-year fixed, the 5-year mortgage, because it's tied to the 5-year bond yield, will also come down if 5-year bond yield comes down. So Kannan, great question. And so again, like I said, we're all waiting to see what takes place.
Mm-hmm. One thing I believe you missed right at the end is that, right after that takes place, but
that's right. That's right, my friend. Yes.
Back up, right?
So the market will have a nice rebound. Yes,
exactly.
That's
correct. Exactly. So right now, again, before Salvana says it, I'm going to say it. Right now is the time to invest into real estate because based on what we're seeing with all these numbers, next year and also 2024 going forward, the real estate market is going to be strong again. Going based on the predictions we have at the moment. So right now would be the best time to invest. Save the funds. Don't waste them all or spend them all. Save it and find a very good investment property.
That's the right way to end, Gana. That's the right way to end. Everybody has to look for investment. Is going to, if the market is slow, what we have to do? We are not this is just watching. Watching not going to help us. We have to involve. We have to participate. If the market is going down 20%, of course we have to take advantage of it. Exactly. Otherwise, it's not worth to be in this industry and spending time in the long weekend with the expert men and advice we are listening today. That I have a question here. Raj Sinaraj sent me the question. Even he won't explain last week and today also we are almost close to 11 o'clock, Raj. But I tell you very short format. But he said before we buy the gas station, what are the aspects he has to look at it for the gas station side? Raj, this is a big topic, Raj, but the gas station, we will discuss the next class about the gas station, more details. I'm going to touch base on the headlines now. When you buy the gas station, are we buying the sale of business or we are buying with the property? There are two way the gas stations are selling it. And the second one, where there is a franchise one, is a non-franchise one. The profit we're going to make based on the liters or make based on the stock market moving up and down. Most of the time, if we look at the gas station, as from my experience 15 years ago, gas station, the Petro-Canada, for example, giving us, we are the gas station owners, we are everybody else. Everybody else those days maybe 99.9, everybody else 1% reduced to 98.2, and he sell it out so many liters in that evening and making more money. Each liter is 3 to 4 cents a liter. Now the time change, and whether it's the stock market changes or the gas stations owners also sometimes suffering loss. They are buying and selling gas station from the organizations, some heated adjustments. And the gas stations, most of the income are coming from the gas station store and selling other product rather than the gas. Gas is an aspect bringing them in into the gas station. That's also happening right now because all self-service gas stations, not a labor involved. They just have the card and pump it and go. And the company is coming and filling up the gas because not less capital is involved. And plus, when it's come to the gas station, we need to do the environmental before we buy. If we are buying with the property, we have to do the environmental side. What kind of gas tank we have, iron tank or aspect gas tank at this today's standard, and how many gas stations, how many tanks are there, and which area the diesel works near to the highway. Raj, is a lot of things to talk. Okay, I'll prepare it myself too. Next week we can start with the seller business. We mainly go focus the gas station, as well as we go to other seller business, restaurant business, groceries business, there's so many other businesses. That's been capitalist business rather than the grocery business like capitalist business and the pizza store like service business. We will go all the seller business as well as the gas station branch next week. I'm going to postpone for another 7 days. Have a nice weekend, guys. Thank you very much, Manan. Again, thank you for your time, and we are very successful today. The seminar, over 100 agents came.
Over 100 agents, yeah, over 100. That's good.
Over 100 for the long weekend. Nice summer. Thank you very much, guys. Enjoy the weekend. See you next Saturday morning.
Thank you again, Manan. We'll see you everyone. See everyone soon.
Bye, guys.
Thank you, Silvana.
ஏ ராசா ரைட் ஷேரிங் கம்பெனி ARASA.ca என்ற இணையதளத்துக்கு சென்று தி ஏ ராசா டிரைவர்ஸ் ஆப்பினை டவுன்லோட் செய்து டிரைவர்ஸாக வேலை வாய்ப்பை பெறுங்கள். மாதாந்தம் $4000 வரை சம்பாதியுங்கள். வணிக நிறுவனங்கள் ஏ ராசா இணையதளத்தின் மூலம் மளிகைப் பொருட்கள் மற்றும் உணவுப் பொருட்களை விற்பதோடு வாடிக்கையாளர்களுக்கு டெலிவரி செய்யலாம். தமிழில் தகவல்களை அறியாளையுங்கள். GTA பற்றி 40 ஆண்டுகள் அறிந்து கொண்டவரும் வீடு விற்பனை துறை ஊடாக மக்களால் அறியப்பட்டவருமான சிவா பிள்ளை. 416-854-0005. Taxi broker licensed by City of Toronto. ராசா ரைட் ஷேரிங் கம்பெனி ARASA.ca என்ற இணையதளத்துக்கு சென்று ராசா டிரைவர்ஸ் ஆப்பினை டவுன்லோட் செய்து டிரைவர்ஸாக வேலை வாய்ப்பை பெறுங்கள். மாதாந்தம் $4000 வரை சம்பாதியுங்கள். வணிக நிறுவனங்கள் ராசா இணையதளத்தின் மூலம் மளிகைப் பொருட்கள் மற்றும் உணவுப் பொருட்களை விற்பதோடு வாடிக்கையாளர்களுக்கு டெலிவரி செய்யலாம். தமிழில் தகவல்களை அறியாளையுங்கள். GTA பற்றி 40 ஆண்டுகள் அறிந்து கொண்டவரும் வீடு விற்பனை துறை ஊடாக மக்களால் அறியப்பட்டவருமான சிவா பிள்ளை. 416-854-0005. Taxi broker licensed by City of Toronto.